This is about the impact of a sales tax on a market and the calculation of the change in consumer and producer surplus and calculation of deadweight loss. We start with a market in equilibrium where supply and demand come together with equilibrium price, PE and QE, and we're going to shift this by imposing a sales tax. So the supply curve shifts to the left because of the imposition of a sales tax, capital T. This is a lump sum tax, not an ad valorem. The only difference is the ad valorem would be a percentage of the sale price, and the curves would not have a parallel shape. Other than that, the analysis works for both. So the first thing we see is a new equilibrium emerges at quantity Q2. The sales tax has clearly caused less quantity to be consumed at equilibrium. And those who are buying the product are paying a higher price, P2, and the companies who are selling this product receive a lower amount, which I've labeled C. The difference is the tax going to the government. The amount of the tax can be seen as the area of the blue box. And as you can also see, some of that revenue going to the government came from the consumers in the form of a higher price, the upper part of the box, and some came from the sellers in form of a lower price received. So they've shared as well. And as the box to the side shows, tax revenue is divided between the consumers and the producers. How much that division is, whether it's half and half or consumers pay more or less, depends upon the elasticities of the supply and the demand curve. The red triangle shows a dead weight loss. And the reason it's called a dead weight loss is because in the movement from QE to Q2, two things have happened. Demanders have not been able to satisfy their desire for the product that they would have at PE. So they've lost, and the area under the demand curve is considered a loss to them. Producers, on the other hand, have not been able to sell the amount between QE and Q2, and for that matter, they also have lost, and the area under the supply curve is the cost of that loss. So what has happened when you lose a cost, it's really kind of a benefit. We don't get the product, but the company didn't have to pay the labor and so forth. So that's a benefit, if you will, area under supply curve. The cost to the consumers is much greater, and it's greater by the amount of the deadweight loss. Just to finish this out, what if there were numbers here and we could actually look at what the sizes are? Then we would see there would be $160 revenue raised from the consumers, $240 from the producers, for a total tax revenue of $400. We would also see a dead weight loss of the $20 that came from the consumer side, if you will, the $30 from the producer side, for a total dead weight loss of $50. And finally, I showed a loss of consumer surplus, which is the $160 and the $20 from the tax revenue and the deadweight loss, and the loss of producer surplus down there in the corner.